Good morning, Mr. Hi, Dr. Bhavna Rawat today is going to deliver this lecture on an important topic account, which is International Accounting Standard I-21, that is, effect of changes in foreign trade. In order to ensure that students should understand this topic in a better way, it is expected that the student should be pre-equipped with the following aspects, which include concept of international business, modes of international business, impact of international business in context of accounting, as also concept of foreign currency. Considering the expansion of business outside the domestic territory of the home country and the complications arising from of foreign currency, this lecture will cover that an entity should follow in the translation of foreign currency as covered under IAS 21, International Accounting Standard 21, that is IAS 21, which illustrates effects of changes in foreign exchange rates, thoroughly covers various aspects related to foreign currency transactions in entities. In this regard, it covers initial treatment with regard to business transactions which involves foreign currency. The standard also involves accounting treatment with regard to transactions that has settled out during the year related to transactions which involve foreign currency. The standard also involves accounting treatment with regard to unsettled transactions, that is, transactions which remain outstanding at the end of the reporting period. IAS 21 within its purview includes concepts related to different types of exchange rate. According to IAS 21, different types of exchange rates that, that may include historic rate, which is nothing but the rate which is in existence at the date of the transaction or at the date on which transaction has taken place. This historic rate is sometimes is also referred to as spot rate. Another type of exchange rate that is applicable in IAS 21 is your closing rate. Closing rate is the rate which is in existence at the end of the reporting year or at the date on which the financial statement of the business entity is prepared. The third type of exchange rate that is applicable in IAS 21 is the average rate, which is nothing but the average rate throughout the accounting period. In the context of IAS 21, the assets and liabilities of the business entity include monetary items and non-monetary items. Monetary items are considered those items which can be easily converted into cash. Some of the examples of monetary items: receivables, payables, loans, etc. On the other hand, non-monetary items are those items that give no right to receive or deliver cash. The examples of non-monetary items consist inventory, land and building, plant and machinery, etc. IAS 21 comprehensively classifies currencies under two broader heads. These include functional currency and presentation currency. Functional currency is considered as the currency of the primary economic environment in which an entity operates. This will usually be considered as the currency in which the majority of an entity's transaction takes place. In contrast to this, presentation currency is the currency in which the financial statement of the business entity is prepared. Considering the complications that may arise in identifying currency as functional currency for this entity, IAS 21 has identified certain factors divided under primary factors and secondary factors, which will be helpful in easy identification of currency as functional currency for business entities. The primary factors in this regard include three major aspects. The first one in this regard is the currency that mainly influences sales prices for goods and services. The second factor within primary factor is the currency of the country whose competitive forces and regulations mainly determine the sales price of goods and services. The third point within primary factor to identify any currency as functional currency, the currency that mainly influences labor, material, and other costs of providing goods and services. If the primary factors as provided above are inconclusive in identifying currency as functional currency for business entities, then the following secondary factors should be considered for the identification of currency as functional currency. The secondary factors include the currency in which funds from financing activities are being generated, and second secondary factor, the currency in which receipts from operating activities are retained. IAS 21 includes mechanics related to translating transactions, or we can say it also underlines the accounting treatment which has to be undertaken while translating transactions related to foreign currency. According to IAS 27, initial transactions are required to be translated using the historic rate prevailing at the transaction date. Alternatively, the average rate can also be used if it does not significantly fluctuate during the accounting period. In case of settled transactions, or we can say that the transactions with regard to which payment has been made during an accounting period, IAS 21 requires that such transactions should be translated at the date of payment or at the date of receipt using the historic rate prevailing at that date. However, as this may be different to the initial transaction, an exchange difference may arise, and thus such kind of exchange difference should be posted to the statement of profit or loss. This is a question taken from ACCA study material so as to explain how settled transactions are dealt under IAS 21. The question is, On 1st April 2018, Collins Company, a company that uses the dollar as its functional currency, buys goods from an overseas supplier who uses from it as its functional currency. The goods are priced at from its 54,000. Payment is made 2 months later on 31st May 2018. The prevailing exchange rates are on 1st April 2018, 1.80 kromic is equal to $1. On 31st May 2018, 1.75 kromic equal to $1. Based on the given information, you are required to record the journal entry for these transactions. Based on the given information, we can identify that the initial transaction which took place on 1st April 2018, the exchange rate of Comet against dollar is 1.75. Therefore, the initial transactions need to be translated at the historic rate applicable on the date of transaction. The resultant impact of translation will be that $30,000 becomes 2. The journal entry in this regard will be purchases debit to payables with amount $30,000. The information from the question further includes that the transaction has been settled during the reporting period itself. Therefore, this is a case of settled transaction, and as the rule says that in case of settled transaction, the transaction has to be translated at a historic rate applicable on the date of settlement. Therefore, we will be converting 54,000 value in terms of dollars considering the exchange rate applicable on the date of settlement. The resultant value which we are going to get will be $30,857. Since the due amount was 30,000 as on the date of the transaction and the amount due on the date of settlement is 30,857, therefore there is a resultant loss of $857. The resultant journal entry on the date of settlement will be payables debit with the amount of $30,000, profit or loss account related to foreign exchange loss to the extent of $857 to cash account with the amount of total payment which will be on the date of settlement, that is $30,857. IAS 21 with regard to unsettled transactions states that if a transaction is still unsettled at the reporting date, there will be an outstanding asset or liability on the statement of financial position of the business entity. If the asset or liability is a monetary item, it should be retranslated at the closing exchange rate. However, if the asset or liability is a non-monetary item, it should remain at the historic rate in the books of the company. Exchange differences which arise on the retranslation of the monetary items, and these are also posted to the statement of profit or loss of the business entity. Here is another example taken from ACCA study material to clarify the accounting treatment related to unsettled transactions. On 1st January 2016, company, a company that uses dollar as its functional currency, buys goods from an overseas supplier who uses dinar as its functional currency. The goods are priced at dinar 35,000. Payment is still outstanding at the reporting date of 31st March 2016. The prevailing exchange rates are on 1st of January 2016, 1.75 dinar equal to $1. On 31st March 2016, 1.9 dinar equal to $1. Based on the given information, you are required to record the journal entry for the transaction. Based on the given question, since it is a case of unsettled transaction, therefore, initial transaction will be recorded at the historical rate applicable on the date of transaction. However, on the reporting date, since the transaction remains unsettled, therefore, the translation will be made on the basis of exchange rate applicable on the closing date of the balance sheet. The resultant profit or loss will be transferred to P&L account, and the resultant liability on the closing of the accounting year will be transferred to the statement of financial position. To sum up, in this lecture, we have covered aspects which are being covered under the purview of IAS 21, effect of changes in foreign exchange. Within IAS 21, we have also discussed about different types of exchange rate. We have also included aspects related to assets and liabilities, as also accounting treatment in case of initial transaction, settled transaction, and unsettled transaction. Herein are the various sources that have been utilized in order to compile this lecture. Students can further access the sources so as to ensure better understanding of the topic. Thank you and have a great day.